We're Compound Everything. We talk money markets and investing. And today we're going to do a book review on the book 100 to 1 in the stock market, written by Thomas Phelps. So maybe we'll start with the background a little bit of Phelps and go from there.
Sure. I got to say from the outset, this is actually one of the better books I've read in the past while.
This is my second time reading it.
Yeah, I've read it
For
twice
you
too. Yeah. So I will say if you want to get the most out of the book, it's probably best to actually read the physical book because there's a lot of charts and numbers. But if you actually want to see proof in the charts and proof in the appendices in terms of how these stocks and whatnot worked out, how people were able to turn basically $10,000 if you were smart enough to buy these stocks and turn it into $1 million. He gives a list of like 365 stocks at the end of the book,
Yes.
which is actually quite impressive when you think about
Yes.
it. So let's talk a little bit about Thomas Phelps. Firstly, there's not a lot about him. So interestingly enough, for such a highly recommended book, like I go on book lists and this book's on there a lot. I'm
Yeah,
gonna say
it
that
is. A
from
lot
the
of
outset.
people reference it too. A lot of big investors.
Yeah, so interestingly, there's really not much known about the author, but his principles, I think, are quite good, and that's what's the important part, I guess. But he lived for 90 years, so he was born in 1902 and lived to 1992. And his investment career spanned about 40 years. And in the end of his investment career, I think he retired sometime in the 70s, early 70s, I believe. And he was a partner at an investment firm, essentially. And so I guess it says, you know, in his biography that his investment career, again, spanned 40 years. But in that time, he also was a journalist. So he worked for Wall Street Journal, and I believe he worked for Barron's as well, if I'm not mistaken.
I think he was like a chief editor.
Yeah, I think he's a chief editor and whatnot of Barron's. And so, I mean, he's fairly well credentialed, but I couldn't find much about his returns. I couldn't actually find anything about his returns. And I couldn't find anything about his education or early life or anything like that. So
or his net worth.
his net worth.
I was trying to find his net worth.
None of it.
None of it.
Yeah, so that was hard.
All his principles are true, and a lot of guys that we do know their net worth, and we do know how much money they're running, and we do know their compounded annualized return adhere to the principles in this book.
Yeah.
So it has backing of them, but I wanted to know what he did, just to, you know, because I just feel like it would have been interesting to know given his philosophy in investing, but
Yeah.
I couldn't find anything.
So I guess from the outset, the question becomes, is it possible to choose a stock that's going to turn $10,000 into $1 million? That's what 100 to 1 is. You're looking for the Peter Lynch Hunterbagger,
Yeah.
right? And so he goes through how it is indeed possible to choose those stocks, but you got to do two things. You got to buy right and you got to hold on. And so essentially you've got to disregard the vicissitudes of the market. And oftentimes he would say there's many opportunities to buy into these gems of companies. You just have to have the foresight, I guess, to do that.
And that's actually the entire, if you could just boil down the book to one sentence, that's the sentence. Buy right and hold on.
And hold on, yeah.
Now, I wanted to say a couple things about this book. It was written in the 70s. So I guess you said he died in 92.
He died in
So
1992.
he were at 90.
Well, you would have been about 90.
So he wrote this book in his 70s.
Yeah.
He would have been around 70 when he wrote it.
So the interesting thing, just as a side comment is, and sorry to interrupt you, but one of the interesting things as a side comment is he's had a lot of investment experience at this point when he wrote the book. So he's not a guy in his 30s who's kind of wet behind the ears. He's actually had some experience.
Yeah, so he's looking back.
He's looking back over his
He's kind
career.
of looking back. It's almost like an autobiography in
Yeah.
the sense of his investing career, probably.
You get that when you read the book. You know,
Yeah.
if I had done things again, I would have done them maybe a little differently, or this is kind of what I was doing at the end of my career. So interesting. Yeah.
So he wrote it. So a couple of things that caught my attention right from the beginning. He wrote it in the 70s, early 70s, and he's talking about the time. He's talking about the time frame from 1932 to 1972.
Yeah.
That's kind of his time frame that
Yeah.
he's covering in this book.
Yeah.
Now, it's interesting to me that he used $10,000 because right from the start, that tells me that no matter what people say, and I know that there are a lot of people out there who say anyone can get wealthy, anyone can grow money, but right from the start in this book, you realize you really need money
To make money.
because $10,000 in 1932, like we hear $10,000 and we think like, okay,
that's doable.
Not everybody could do that, but there's a fair amount of people that with saving their money and really cutting back on costs, even in this economy, could probably come up with $10,000 after a little bit of time and put it in. But at that time, I think that's like 4 doubles, 5 doubles. I think so. You're looking at like $250,000 to $300,000 now.
That's a handy chunk.
That
change.
is not that is not a small amount of change.
Yeah.
So he's writing this book for people who have money. And he doesn't say that. And here's the thing. You could say, well, why wouldn't you want to just take 1,000 and turn that into 100,000? And that's totally fair. And you could do that too. But the fact that he used $10,000 as his amount meant in his mind he was writing this book for not the average earner.
Yeah. I mean, even if you take it from 1970, so at the end point of his time frame, when he's writing it from that perspective, I mean, $10,000 was still a reasonable sum of money.
Right.
Yeah. So, I mean, if you really think about it, then, not everyone had $10,000 lying around.
No, it could have been like clickbait. I know, like, that didn't exist because, you want the $1 million to be said in the book. So I understand that. But it's just, it caught my attention that he would use 10,000. Because right away when he said $10,000, I started running through my head, like, what is that in today's dollars?
Yeah.
Right? Because he's writing with that in mind.
Yeah.
And so, like I said, if you don't have a lot of money, you obviously, like, why money grows, whether you put $1 in or 10,000. So, like, you should still be growing your money.
Yeah.
But it's a lot harder to make $1 million when you're not starting
with a fair amount of capital.
I
mean, at the end of the day, what he's advocating for is essentially, in today's dollars, turning $1 million into $100 million.
Yeah.
Essentially.
Yeah. And here's another interesting thing, and there's a lot of discussion on socials about this. But people will say, like, oh, 100,000, and I'm not even going to go to the $1 million mark here. They'll say 100,000 isn't what it used to be, or people living on 100,000, like, paycheck to paycheck. But the funny thing is, it really isn't what it used to be. Now, you can argue, like, oh, these people making 100,000 and more should just shut up because they still have a good living, or how on earth can they be living paycheck to paycheck? Like, you can say all that, and you can be in that camp.
Yeah.
But regardless of what camp you're in, $100,000 today is not what it used to be. $1 million today is not what it used to be. So he wrote this book in the 70s, and he was saying, like, the $1 million was like the right?
You were a millionaire.
You were a millionaire, and people loved that, and it was like, you have reached like
you've made it.
Because that was in the 70s.
Yeah.
But we still think like that.
Right.
We still think if I just had
$1 million.
It is really like those psychological, totally a digression from the book, but those psychological numbers really do get stuck in our head generation after generation.
For sure.
Even though inflation has eaten away our purchasing power at 2% at the least, compounded annually.
So speaking of inflation, he has a very good chapter on inflation. And in his chapter on inflation, one of the things he says is basically inflation is cheating. Essentially what he says is governments are trying to print money and get something for nothing.
Yes.
Is essentially what he's saying in his argument throughout the chapter. And I thought that was very pertinent to today.
Yeah. I didn't write a lot down on that chapter. It had to do with inflation and interest rates. And I think if you were reading this book when it was written, that would have been much more educational because people didn't have the same idea, didn't get the same information so quickly. But now if you're into finances at all, every day there's an article on interest rates. Every day there's an article on inflation. So I just didn't write a lot down because I figured our viewers probably have a good sense of that.
Yeah, for sure. And I think, funny enough, when he wrote that book, would have been a time where inflation was getting to be a little bit of a problem for the United States. So maybe that's why that made it in there. I'm not sure. It was pertinent at the time. But
it was really...
I thought it was a good chapter nonetheless, because it's still pertinent now.
Oh, very. The things he read, if you didn't know, you would have thought it was written today. Like
absolutely.
Things he wrote about inflation. I was like, oh, wow, like this could have been written yesterday and you'd have no idea. So I'm going to go back to the beginning to just start back at chapter 1.
Yeah.
So he said, starting in 1932, so we had the stock market crash in 29, and then there was a huge rally.
It was a recovery,
and then there was a bigger drop in 1932. So starting in 1932, and going 40 years out, there were 360 different stocks that you could have turned 10,000 into 1 million. And
that's unbelievable.
He continues to go through, and this is why I recommend reading the book, but if you don't want to, we're just going to sum it up probably in about 40 minutes. He continues to go through how, you could have bought at the trough, and that would have been just even more astounding. But there were many companies where you had many times over to buy back in and still get that Hunterbagger by the time the 1970s rolled around. So to me, when I read that, I was like, that just, hammers home the whole time in the market is greater than timing the market. Yeah.
And so I think that's on the other side of it is if you're one of these stockholders who owns this stock, it also means you have to have the fortitude to withstand the dips. As it roller
And there were
coasters
some
down,
big dips.
there was some dips, and some of these companies, troughed big time. They lost maybe half their value, or sometimes a little bit more, in the process of going to 100x their initial starting purchase.
Well, and that's one of the things he says. He says buying right and holding on isn't just buying right and forgetting about it.
Yes.
He says buying right and holding on is buying right. It's a good company. He focuses on it has to have a lot of history for you to look at it. Earnings. He's an earnings guy.
Yeah.
The company has to be continuing to increase their net worth and ROIC. It was huge to him. And he said you have to keep looking. Like, you can't just buy a stock and then leave it and forget about it. So he wasn't into the coffee can investing. He was into, you're going to buy a good company.
Yep.
You're going to buy it at a decent price.
Yep.
And you're going to hold on to it even when it's flying high.
Yeah.
But you have to do your homework to know what the value is.
That's right. And maybe this is a little off track potentially, but one of the things that he doesn't say necessarily in the book that we noticed from reading the book is some of these stocks that he references in there are no longer with us.
Most.
A lot of them,
I went
actually.
through the list, and maybe they are, but I didn't recognize them as big companies.
Yeah. So one of the ones that he touts as being a major winner, and in fact was one called Haloid, which is also known now as Xerox.
Right.
And so Xerox was one of those 100-to-1 stocks, which if you were lucky enough to purchase, you made many times your money on. But at this point, I don't think if you're still holding on to Xerox, I'm not even sure if it's publicly traded anymore. It doesn't have the same impact it once.
Also, Polaroid was another one.
Polaroid was another one. Another one that you noticed in there, but has now been taken private, is Avon. And so I don't think they have the same kind of market share they once did.
Yes.
And so I think you have to buy right, hold on, but also watch your basket carefully.
Yes.
If I was to take any lessons away from this book, that would be it. Yeah,
for sure. And that's, again, like he said, I think at one point there's an exact quote where he says there are two things that make a great investor. One is the amount of work they're willing to put in. So he says, like, the fundamentals.
Yep.
And the other is the emotional control.
Oh,
and
absolutely.
those two things together will make an astounding investor.
Yeah.
And the reason you need the first one, let's talk about the education and the learning and the digging deep, because there was a time to sell all those companies you just mentioned.
No question.
It wasn't just put it in a coffee can, put it in the ground and leave it. Because when you dig up that coffee can now in in the 1970s, you would have been pleasantly surprised.
Yeah.
If you put it back in and dug it up in 2023, you wouldn't have been pleasantly surprised.
There'd be moss in there.
Yeah, exactly. So there is a time to sell.
Yeah.
And when I read this, I really struggled with that saying where a lot of people like to quote it. I think it's by Buffett, the best
holding time is forever.
The best holding time
We've
is
discussed
forever.
that a lot, me and you.
And I just don't think that's true. I think that's one of those things that's like in a hypothetical perfect world. Yeah, that's the best thing to do. But we live in a messy, competitive world. And there is a time to sell because you want to sell these 100-to-1. You don't want to write it up 100x to write it down to zero.
Well, and one thing you told me the other day, which I think was very salient, you said, and it's very true, businesses have lifetimes.
They do.
And so businesses, come and they grow. They grow and then they die. And so at some point, there is probably a time to exit even a wonderful company.
Thomas Phelps would say it's when their earnings start to decline.
And I like that. See, it gives it at least an objective measure as to when you should maybe get out of some of these Hunterbaggers.
Because he said if you're holding a company, and he gives so many examples, it's actually very interesting. He gives so many examples of if you bought here at this price, you could have sold here. Oh, but if you missed it here, you could have bought again here later. Because what he was trying to do was, I guess a lot of people disagreed with him, saying, oh yeah, well that person was lucky. They caught the 1932 trough. Sure. And so he gave a lot of examples where, oh, well you could have bought in 32, you could have bought again sometime in the 40s, you could have bought again later in the 40s. Like he gives a lot of examples of that. So if you're waiting, so if you buy at the trough, you buy at one trough, because he gave all those examples, like I said, where it was like trough up, and then you have to watch it go down again.
Right.
What made him know? Because you could be holding a Nortel.
Sure.
Or you could be holding an Amazon.
Yeah, you didn't know.
Right. And what made you know is that you dug deep into their accounting. Yeah. And what's even crazier is that he didn't have the same access that we do today.
That's
so
very
we
true.
have no excuse.
That's true. That's a very good point, actually. Information is so much more readily available now. I mean, at his time, you would have had to
Get it in the mail.
mail the company for their shareholders reports and whatnot.
And you wouldn't have had access to things like Value Line.
No.
You wouldn't have had, eventually, yes, but
Yeah.
even that probably would have been quite pricey for the average person.
Yeah.
You wouldn't have access to things like Morningstar,
Nope.
Guru
Focus. Yeah.
all of those things where they actually like parse through and they just spew out the ratios for you.
Oh, the information is all there. It just falls into your lap.
Yeah, you were running your own numbers.
So why don't we talk a little bit about metrics? Like, how are you going to nail these companies down? I think he gives a little bit of an inkling on how to do that and how this kind of the mechanics of this whole thing works. So why don't you take that away?
Okay, so I actually wrote a list of what I think he is looking for to identify making or finding a 100-bagger. Here are my main takeaways. Okay, number 1, hold a winner for as long as the story stays the same.
Okay.
Number 2, most 100x stocks will be bought if the company is bought at a low PE, particularly in comparison to the Dow Jones average PE. Now here's the thing, he didn't have the S&P, so he always used the Dow Jones.
Yeah.
Okay, number 3, look for companies that do something 10x better or will make people's lives 10x easier. And so that goes back to the number 1, the story stays the same. So an example he gives in the book is Tampax.
I was thinking the same
Tampons.
thing. Yeah.
So that actually was revolutionary for females, like especially for like athletic females.
Yeah.
That would have been a revolutionary invention.
Well, and the funny part is he goes a little bit into Tampax at the time and how people or Wall Street was kind of throwing it to the side, saying, "Well, they can't advertise; it's not going to grow because there was
because the women's product,
because it's women's products, it's private, and they had barriers to advertising and whatnot." And that thing flew.
Yeah. Okay, so that kind of goes with the if the story stays the same.
Yeah.
So maybe if something had come along that was even more like it made things even easier for women, and maybe eventually that was probably like birth control because then you could just skip your cycle altogether.
For sure.
That's another, but I don't know how, I've never looked into that, so I could be wrong.
Sure.
But that would have been one of those things,
Yeah.
maybe. Okay, number 4, ROIC of greater than 9%.
Okay.
Consistently.
Okay.
Never just 1 year. So
Right.
ROIC greater than 9%. Number 5, earnings power is key. A company must have fantastic earnings power and must be growing their earnings. And that again goes back to number 1.
Yes.
The story needs to stay the
Yeah.
same. Number 4 and 5 kind of go together.
Yeah.
If they have a good ROIC, they're going to have good earnings power.
Yes.
Number 6, a moat is important. That goes back to number 3. They must do something 10x better
Yes.
or make people's lives 10x easier. And 7, a margin of safety is a must. Because he doesn't want you to buy. He explains why you shouldn't be buying when the PE is 60, 80,
Yes.
100.
Yeah.
And another time, because he says, how is that PE going to like keep going when the Dow Jones average
Yes.
is way below
It's
it?
15 or something like that. Yeah.
And then the other, he's like, it's unrealistic. And the other good point he said is like the other thing to watch, and this just goes back to like some more fundamentals, is market cap.
Yeah.
Right? So for instance, now if you're looking at Apple, like can Apple really 100x? Because he said eventually they're going to become the whole economy.
Yes.
That was a very excellent point. So those were kind of like, if I had to do an overview of the book, those were my main takeaways of how he found a 100-bagger.
So let's talk a little bit about kind of how the mechanics work on the Hunterbagger. So he alludes to something that we've talked about in another video when we profiled Shelby Davis, and that is the Davis double play.
Yes.
He doesn't call it that, but the mechanics work the same.
Yeah, and a lot of people talk about the Davis double play.
Yeah.
They never call it that, but we just loved how Davis named it. So go ahead and explain it.
He kind of named it after himself, which is funny. But anyway, essentially what ends up happening is in order for a stock to 100x, you need to have improving earnings. In the short term, the stock market is a voting machine, but in the long term, it is a weighing machine. And so ultimately, any increase in share price is going to have to follow increase in earnings, bottom line. And so what ends up happening with a good company is they're going to consistently grow their earnings. And that was why he thought it was so important that a company have consistently growing earnings, right? In order to reflect an increased share price.
Yeah.
So without an increasing earnings, the share price is not going to appreciate, or if it does, it's going to be temporary.
Yeah.
So what happens is when you start to get an increase in earnings is the share price follows, but also people will start to pay higher multiples. So let's say a stock starts with a 10 times multiple of a price to earnings. So they're earning $1 and people are willing to pay 10 times earnings, so the share price is $10. So let's say, though, that their earnings increase to $2. So now shareholders start to take notice, and they go, wow, the earnings is increasing fairly rapidly. And now they're willing to not pay a 10x multiple, but now they're willing to pay a 20x multiple. So what do we have now? So we have $2 earnings per share times 20x is $40 per share.
Whereas before you had $1 of earnings
$1 of earnings per share.
And a 10 multiple.
That's right. So $10 quickly turned into $40 per share. So you basically 4 times your money. And so he said that essentially you're relying on that not only increase in earnings, but also investors willing to pay more for the shares because those earnings are steadily increasing. So just take it at its roots. If no one was willing to pay a higher PE multiple for your shares in the future, you'd have to rely exclusively on earnings.
And the nice thing about that is that you can there's a lot of opportunities in companies where bad news happens to this company, or they hit a patch and you kind of know it's temporary if you're looking into it, where their multiple will drop, but the company is still not a mature company. It's a little bit out of the baby stage, so you know it's sticky, you know it's good, they've proven themselves, but they just have this like moment in time, and you know their earnings are still like growing, and then all of a sudden, boom, they get that multiple drop because investors get scared, and that's a really great opportunity to jump in to find these 100 baggers, because you know the point that people might push back on is, well, then you have to find new companies. How are you going to find these new companies where their earnings are growing so fast and the multiple's low? Because as soon as, you know, a crowd draws a crowd, as soon as the companies love that multiple, you've missed it. But there are always opportunities. We saw that in Chipotle back in, 2017-ish? Right? We've seen that in Meta. Right? We've seen that in oils. We've seen that in lots of different, those are 3 different sectors where we've seen companies that have been able to do both, and you had the opportunity to get them in that multiple tanked.
That's right.
On bad news.
And he goes through a little bit of that. There's a section in the book where he calls out how to find some of these companies. And a few of them would be, you know, is it a new industry or in a sector that's unloved at the time and whatnot. And so he gives some of these.
I have a list, actually. Okay. There are 4 categories for 100 to 1 stocks.
Okay.
So event on a good company.
Okay.
That's what I was kind of
So a bad
about.
event.
A bad event. Yeah, or bad press.
Sure.
But something you know, because you are so familiar with this company, that they're gonna weather that storm, and it's not gonna be a big deal.
Okay.
Number 2 is cyclical.
Cyclical companies,
Cyclicals can be a good place, but with cyclicals you got to be a little more concerned about that exit strategy.
Yes.
Because it is cyclical. Macro. So sometimes he would say the macro environment really will depress your stocks, and and he lived so long that he was able to see that the macros always change back and forth, they ebb and flow, and so it is quite interesting where we're at now, because a lot of the information that's out there from younger people, they haven't lived the ebbs and the flows, the ups and the downs yet, so they get really panicky about what's going on right now. So he said the macro, and then the other way to find one is to have a CEO who is an amazing capital allocator. And every time I read these books, I just think all these guys that we follow all read the same books. Because it's either they read the same books or they've just learned the same lessons, because there's nothing new under the sun.
Well, let's talk about that point for a second, because he makes a point actually in the book to say, don't rely on a one-man show. And we talked a little bit about that, and we thought, we were reflecting back and saying, I'm not sure if that's true.
Yeah, we kind of disagreed with that point.
We kind of disagreed with that point. And I mean, I understand where he's coming from. You don't want a CEO with a large ego and whatnot who kind of assumes himself to be the smartest man in the room all the time.
Right.
Rather, he talks about one CEO who's quite humble and would always look for, you know, good people to surround himself with. But I think at the end of the day, a good CEO, and even a CEO who's a bit of a rock star, is going to do that anyway. And we thought of a few companies recently that, well, think of Jeff Bezos. We think of Elon Musk. We thought of Jensen Huang, Lisa Su. You know, all these CEOs who seem to be kind of these one-man shows who've managed to do amazing things for the company. So I'm not sure I agree with that.
Yeah, I 100% disagree with that.
Yeah.
It's interesting because I love a founder CEO.
Oh, totally.
And a founder CEO is generally a one-man show. Now, that being said, they usually, if you have an amazing company, you have that work ethic and that drive and that productivity and that foresight to hire other guys and girls who have that same drive and productivity and foresight, and you build yourself a fantastic team. And of course, that team helps you get to where you are.
Yeah.
But that one-man show is why they're there. It's because of that
That's why they've got notoriety.
Right.
Yeah.
And so I was like, oh, I actually, like, if I can find a rock star founder CEO, like, I'm gonna bet on the jockey every time.
Oh yeah, no question. Well, let's talk about the contrary, because he also makes a point to partner yourself with CEOs you can trust.
Right.
And one of the points he makes in the book, which I thought was very pertinent, he said, oftentimes in companies, if there's a CEO who's maybe not so trustworthy, often the roots end up going deeper into the company. So he would say basically avoid a company where there's a CEO at the top is maybe a little less than trustworthy.
Yeah.
Because oftentimes those people hire people who are like themselves, a little less trustworthy, and that permeates through the business.
And you see that in businesses.
And you do. And he said it's not as easy as firing the guy at the top.
Because that culture, that dishonest and snaky culture has moved because they're going to hire dishonest and snaky people.
Yeah.
Phelps said this. Never go into a business with a man you can't trust.
Yes.
And then he went on to say how if you're buying even one share, you are going into business with that person.
That's right. When you buy even only one share, you become a business owner.
Yep.
And there's actually I'm going to kind of paraphrase a part in the book that really stuck with me. And it's simple, but the idea is still there. And one of the things he said is just that when you are an equity holder, you're a business owner. So when you buy a stock, you're a business owner. Yeah. But at the same time, a lot of these same businesses will have bonds out. And you can go buy the bonds in those businesses. And when you become a bondholder, you are a creditor.
Yes, that was a very interesting side point.
And that was an interesting side point. So funny enough, if I look at a business, so let's say Apple, for instance. I look at Apple and I can be an equity holder and I can be a partial owner of that business. Or I could be a creditor to the business, funny enough. And at the end of the day, if you look at a business and deem it worthwhile, you have to go back and say, okay, well, how does this compare to other businesses in the industry and in the stock universe? Is it going to generate me more returns? And then if you can narrow down and say, yes, this is a good business, one of the other things you should maybe start looking at, and this is what hit me, is it better to be an equity holder or is it better to be a creditor?
Yes, that was a good point.
That was a very good point.
Every investment needs to be held up against other investments.
That's right. And so every investment you make should be held up against not only other stocks in that universe, but also sometimes against itself. So do you want to be a shareholder in the business again, or do you want to be a creditor to the business? Where are you going to make the most money?
That was an excellent point.
And I thought that was super interesting.
Yeah. I'm gonna go back to the metrics quickly.
Sure.
He said he doesn't love TA, so that's technical analysis, like charts and everything.
Yeah.
But he does believe there is something to it. There's a little bit to it.
Yeah.
And then he went on to say that if TA and fundamentals collide, that is something that you pay attention to. And why that caught my attention, because I don't do TA
nor do I.
Most part, is that Lynn Alden said the same thing. Probably about a year ago in a newsletter.
Yeah.
And she said, when I look at fundamentals and I do TA and, sometimes you want to invest on the fundamentals and sometimes you invest on the TA. Yeah. She said, but when the TA collides with the fundamentals, you back the truck up.
Yeah, and she's brilliant. We really like Lynn Alden.
She's like one of the smartest people that I read.
Yeah. So it's interesting to see that someone like Phelps and someone like herself came to that exact same conclusion. Yeah. So when people who are quite wise come to that same conclusion, there's probably something there. So just one of the last points I want to make is, and I think it was pertinent, and this is something that I've kind of come to realize maybe a little late, is that in investing, you're dealing with probabilities. You're not necessarily dealing with certainties because you're dealing with the future, right? So I think it was a really good point in his book that he made that you're not dealing with certainties and there is some risk, but what you're trying to do is look for plays where the probabilities are heavily in your favor. And I thought that was quite good. So even from that perspective, I found that chapter worth a read and worth the price of the book.
The probabilities chapter was probably one of the best.
Yeah.
Another point, you mentioned risk, and this just came into my head now. He talks about investing abroad, investing in emerging markets or investing in foreign markets.
I'm glad you brought that because I was hoping you would.
It slipped my mind until you said risk. And he said the issue with that, he wasn't against it. But he said, always remember, you are trading the risk that you can see.
Yes.
For risk that you can't see.
Yeah.
So he's like, there might be risks in these other countries that you actually don't know of because you don't live there. Now, of course, today we have more information, but still living somewhere gives you an edge in that market.
That's right.
And we even find that, funny enough, being Canadian, that we don't have quite the same edge on some of the American companies because we don't have those companies here.
We can't see them. And we've
missed a few of them and we thought, do we take people's word for it?
Yeah.
Like we would talk to some people that we know online. just through social media platforms and be like, oh, like, are there still lineups at XYZ?
Yeah.
And they'd be like, oh yeah or no or whatever. And we're like, well, we just can't see it. So like, how much stock do we put into there?
Yeah. Well, for us, Chipotle was a great example of that.
Yeah.
We could see that the stock was dipping, and we could see that...
And we could see the fundamentals.
The fundamentals were there, but we're like, oh, I've never tried one of their burritos.
Right.
And it wasn't rocket science, the business.
No, and we missed it.
And we missed
all
it.
because we didn't feel comfortable.
Yeah.
Now that was just stupid of us, but again, like, we didn't know because
Yeah.
we didn't see the lineups around the store.
Yeah.
And of course, haters love to go online too. So then you get all the, oh, it's dirty in there, and that kind of like
Sure.
spooked us, and that was our fault. But
Yeah.
needless to say, he does say be careful because you are
Yes.
trading risk.
That's right.
And that was an example of why we probably should have just gone with the risk we couldn't see
Sure.
and proved him wrong in that.
Sure.
But
Yeah. But I think again, the point is a very salient one. So for instance, for us as North Americans investing in China, there is risk there that we're trading that we can see if we were to invest in companies here. So for instance, if we buy a retailer here, we can see whether there's lineups or whether the parking lot is empty. But if you buy, some of the Chinese retailers, you have no idea.
right, there's no, we don't know, and we don't really know. We get the numbers,
Yes.
if you want to believe Chinese numbers.
Yes.
But we get, if you want to believe our numbers, I feel like every country lies about their numbers now. But
Sure.
we don't get the overall feel from people on the ground.
Yeah.
Right? Like, you and I felt that we've been in a recession for a few years now.
In Canada.
I remember lying in bed with you being like, have you noticed, like, our friends don't do renovations anymore?
Yeah.
And we started, like, contemplating just seeing people. And then, of course, the numbers come out in the Bank of Canada. They're like, oh, we're not in a recession. And it's like, no, but, like, we are.
It feels like it.
We can see people aren't spending, and you don't get that same on the ground knowledge
Yeah.
in a foreign market.
Yeah.
So something to keep in mind.
Yes. So I thought, very good point, nonetheless.
Yeah. So I have a couple lists that I'll quickly say because
Yeah.
I can't think of anything else.
Why don't we close with that?
Okay. So he said the most important questions to ask.
Okay.
So here was a list from Thomas Phelps. Number 1, how much will what I expect to happen increase the value of this company?
Okay.
Number 2, how long is that going to take, probabilistically?
Yes.
Number 3, what is the present worth of this increase?
Ah.
Number 4, how much of this is already baked into the price? It's priced in.
Yes. Priced in.
Number 5, is there a margin of safety?
Huh.
So those were things that he would step back and ask. Now, there aren't really concrete answers
No.
to these. So it goes back to your probabilistic
Yeah.
conversation that we had just
Yeah.
a few minutes ago.
Well, the funny thing is, we also like to listen to Ashwat Damodaran.
Oh, yes.
Oftentimes. And so one of the things he would say is attach a number to it. If you're thinking that a business is going to do something, attach a number to it.
A story needs a number.
A story needs a number. And it's essentially what Phelps is saying here as well.
Yeah, and here's another list. It says, what makes a stock grow?
Okay.
So, right, we want to find that low PE. We want to find a beaten down stock. We want to find a stock that's going to 10x something that people haven't caught on to or whatever. But what makes those stocks, once you find them, what's going to make them grow? So reinvestment back into the company. You want good capital allocators.
Yeah.
That's number 1. Number 2, if they can invest with borrowed money and be good at it and get more back, watch that.
Yes.
Because that's great. Number 3, if they make good acquisitions, they're buying great companies for they themselves are
worth.
Yeah, the company themselves are value investors.
Yes.
And they can make those acquisitions work because bringing in new companies, there's different cultures that actually can be
Challenge.
Yeah.
Sure.
Number 5, if you're in raw material companies or whatnot, he would say discoveries like new gold, new oil, that kind of thing. I guess fracking would have been one of those things.
Fracking would have been one of those things where, open up opportunities.
Yeah, new inventions was number 6. Number 7, contracts. So you think of companies that just get big contracts, military contracts, maybe be one of them or whatever. And then number 8, of course, is a rising PE, which goes back to the Davis double play.
Yes. In summary, I really like this book. I think there's a lot of wisdom here. I mean, some of the examples he gives are older and maybe a little outdated, but I think there's lessons to be learned of that, even as we discussed. And did you have anything to close off with?
I think I'll just close off. This is the very last sentence of the book.
Sure.
And it just encapsulates all that we've said and everything that the book stands for.
Okay.
So he says, in Alice in Wonderland, one had to run fast in order to stand still. In the stock market, the evidence suggests one who buys right must stand still in order to run fast.
I think that's an excellent
That
quote.
was a perfect way to end
Yeah.
the book, a perfect way to end this conversation.
Yep.
If you could like and subscribe to our video, that really helps, and we will see you next week.